put you all down out of the way. We've got 161,000. That's actually gone up in the last 5 minutes by 1,000. And the stock buying power is at sort of 114. So we've got plenty of stock buying power, no problem. That's going all right. And I'm going to stop sharing that. Oh, you're all in my way down. I'll have to do something about that. Put that down there. And I'm going to share something else instead. Picture of my cat. I haven't got a cat. Right. Can we see that?
Yep.
Yeah, everybody can see that? A spreadsheet. So this is where we're at in fortune. So the top section are the stocks that we currently own. And then we've got, there's very few puts expiring in November. And that's because I've mainly already taken profit on them. And then we've got some potential new ones for selling some more puts to use some of that buying power up. So I'm conscious that when you get the dashboard, you see stocks and you basically sort of say, what is he doing? Because you see these figures here. So CDE paid $9.13, $6 and current price $6.77. So Micawber's not generally very happy, and that's the case in most of them except NABL, where we got the for free in there, $12.75. Let me just have a quick look. Yep, they're all underwater. So what the heck's going on? Well, there's two things going on. One is that when they do get above water, I tend to sell them and take profit. But the other thing that's going on is that the current price and the paid price don't take into account the money that we're being paid as a put, the put premiums, which are here. So in actual fact, the column over on the right-hand side is where they are. So some of them are above water and some of them are below. There's a bit of a mixture, but none of them are horrendously below. The worst one is $3.80. So what I want to show you is why that's not particularly a problem, how we can actually get out of that with a gain at any time we wish. So let's put some figures in. I'll do it down here. So first of all, we paid for ENR, that was the worst one, ENR, $50. So that's minus 50. Oh dear. If we sold them right at this moment, we would get $38.70. So that's $38.70 as a positive. And we've already had $7.50. This is per share. We got 100 of them. $7.50. If we just do a little sum on that, we see that that's the $3.80 that we're down. Okay. So if we go, so we need to get back into the black to get $3.80 from somewhere. So I'm going to stop sharing this and go back to the trading screen. There it is. And go to the option chain. Is that someone's TV? And ENR, here we go, Energizer, these are the people that make your batteries. So if we go forward, there isn't a January, I'll have to go to February. And we go to the puts side of things. Current price is sort of $38, so we want to be above that. So even if we went just one step above that, one interval above it, there is $3.30 available that we can take for selling a $40 put against it. So that would, we need 380, so that wouldn't quite do it. So we can go to 45, and there's $5.70 there. So that would give us, just going back to the, oh, that's somebody in, back to the previous screen. We can now stick $5.80 in there. And lo and behold, we're now $2 up. But not only are we $2 up, instead of being committed to that share at $50, we're now committed to it at 45. So that is how we can get out of that whenever we feel like it. So the question is, well, why don't you then? And I'm going to share yet another screen with you, and that will explain why. Okay, so these are, you can see that these are my charts, and the one that I'm interested in as far as this conversation goes is the VIX. So this is the VIX. It's a measure of volatility, and it is an inverse relationship to the price of stocks. So when stock prices are high, this tends to be low. When this is low, stock prices tend to be high. But the other thing is, when this is high, the premiums that we get for selling options tend to be higher. So I'm basically biding my time to get the best time to do that transaction, to sell that stock and replace it with a put to put them in the black. So that's what I'm doing. As people keep turning up. However, I'm doing well on the sharing here. Share this again. If we also look at that, across on the right-hand side, we've got the forecast. It's not the weather forecast, it's where we expect this stock to get to. So ENR, for example, we think in the short term it will get to 48, and it's at 38 at the moment. So I'm happy to let that just continue up while we wait for the volatility to improve, and therefore the option premiums to improve. But also to the right of that, we've got the value line. So that's the professional research company. Their short-term forecast, which is 18 months, is 52, and their longer-term forecast is 97.50. So I feel pretty comfortable saying I don't have to worry about this for the moment. I know I can get out of it at any time we wish, and I also expect the result of getting out of it to improve as we go forward. Is that okay? Any questions on that? Am I a clever bugger for that?
Just a quick one there. Just a quick one there, Jeff. The 97.50, is that halfway between the high and the low? Because they normally give us that number.
Yeah, it is. Yeah. So in actual fact, what Owen is pointing out is that while the value line both on the 18-month and on the 3 to 5 years, they don't give a specific figure as such. On the 18-month, they do, but it's a midpoint between a high and low that they expect in that period. And for the longer one, 3 to 5 years, they don't actually calculate and give the midpoint. They just give the two figures, top and bottom. I actually calculated the midpoint and put it in. So yeah, that's the average of what they expected to get to over that period. Okay.
Yeah, perfect, thanks.
Yep. Right, so let's have a look at what we've got coming up to expire this week. So Friday of this week is the monthly expiration date. And as we've only got 3 that are due to expire. One is AU, and we have a strike price of 25. The current price is 21. That too, we're looking at a forecast of it getting up to 38, so not too worried about that. I think that's there. GDXU will be paying 57. Currently it's 47, sorry, 50. We'll be paying 47.50, so we're not far away. In both of these cases, in fact, in all three of these cases, when you take into account the premiums that we've had, we're actually in profit by $4, $7, or $1.50. So quite happy to bring those on board and then to manage them from there, possibly to keep them, possibly to move them on, depending on how things go. So that's what we've got expiring on Friday. Prices are expected to sort of fall this week, but they're not actually falling very much. It's sort of a little bit of a strange week, really. But you know, we're okay with them. So any questions on that? Any questions on what's happening on Friday? Does everybody understand what we mean by expiration Friday?
Yeah.
Yep. So briefly, we have promised to buy these shares at these prices at any time up to Friday of this week, and those promises, you know, run out if they make a profit by putting the stock to us, is what we call it when they make us buy them. Then we will. If not, then they won't do it. So okay. So the next thing is I've been looking at possible new puts to sell. We have plenty of stock buying power, about 30,000 or something. And this would, these, according to the prices from a couple of hours ago, would only actually use about 10,000 of it. And the stocks that we are in already in two cases. So in JetBlue, we've already got some of these puts sold, and this would simply be adding to it. It would also be diluting the price that we have promised to pay for them at. And DISC are the same. We're going to add one to it. We've got one that we've promised to buy the stock at 50. This one would be at 35. So we can do that. And we're giving them plenty of time, March, April, February. And then there's a completely new one, American Eagle Outfitters, AEO. And that is really to start taking advantage of the retailers' Christmas season, which is when their stocks do well. By the time we get to February or March, their results should be out, and hopefully they'll have done well. The percentages shown are a percentage in terms of the premiums taken as a percentage of the strike price. So that's what we're looking at. So effectively, they're a discount against the current prices, or against those prices. Everyone happy with that? Anyone got any that they want to add or look at? Oh, you are quiet a lot tonight.
Jeff, can I ask you, what's LID, lid, column G?
Oh my God, how long have you got? You need to do the training. I'll explain it briefly, but you really need to do the training on that. So the lid is the protective trade that we put a limit order in, so that if, for example, we were asked to buy JetBlue shares for $19 and the price was lower than that and below 18, then this trade, if it's triggered, would give us the right to sell them again for 18. So they don't always trigger, but if they do, they guarantee us a profit. But their other major function is, instead of having us exposed, in this example, at $19, we'd be exposed at $18. And that would therefore release a lot of buying power that we can use for something else.
Okay, thank you.
Okay. Yeah, definitely. It's covered in the training. So let's have a look at JetBlue. So we're talking about JetBlue, 3 contracts, $19 strike price for March. So let's have a look at what that. I now have super fast broadband. This is down to the trading platform. I think if it's slow now, JBLU. So it's JetBlue Airlines, one of the few airlines that we look at, a very good airline, and we're going to add an option, and we're going to sell a promise to buy these. So we sell to open. I think I said, I think it was, yeah, 3 contracts at 19. So 3, and the month was March. So March expiry. There it is. Strike price 19. Now, I particularly like stocks where the intervals here are $1, because that means when we put the lid in, we're only going to want $1 down, and therefore, if that does enact, we only lose $1 on that part of the trade. We don't lose it. Our profit is reduced by it. So the prices are 460 by 470. When we see the actual prices, if I verify it, these are delayed by 15-minute prices. So we'll see some actual prices here, 455 by 465. So we'll try and get 460, which is what we've got in there. And if this comes off, we will get basically $1,380, less $15 of costs. And it's pretty low on its use of buying power. Yay, we got it. So we've got now 3 of those. So the next thing is to put that protective lid trade in place. So this time it's a buy to open, because we would be buying the right to sell the shares. It's still 3 contracts in March, but we're going to go 1 strike price down to 18, and we're only going to give 10% or so of the money that we brought in. Otherwise, there's no point in doing it. We'll give them 40 cents. No, it was 460, wasn't it? We'll give them 40 cents. And I never know where that comes up, but I put lid in there as a note. Okay, so that's not filled, but we don't want that to be filled at the moment. So that's just an order, which is a limit order that sits on the system and will only enact if and when the price comes down to 40 cents. Job done.
So Jeff, if you go to orders and add the comments in one of your
is that where they come up?
Yeah.
You found it, have you? Okay.
Go to orders.
I mean, I know that they are anyway. If we go to orders,
and then bottom left-hand corner, you've got the change columns.
I don't want to even use the space up with the columns. I'd rather have something more useful in.
Oh yeah, no, just if you want to know.
Thank you. It's good to understand where it comes from. When this comes up, you'll see that we know anyway which ones they are, because they're in nice green. They're the buy to open ones.
So later on, when we get a bit more sophisticated, Jeff, and we start to do what's called bear call spreads. At the moment, we're doing bull put spreads.
Yeah.
Later on, we get a bit more sophisticated. We start to proactively open up leg 1 of a bear call spread. That's
all right. Yeah. Then you need to know what you're looking at.
One is a lid and one is not a lid. Yeah. I think you might need to just refresh there. Sometimes it does that little. Yeah.
Okay, I'll come back to it. All right. So the second one we want to look at is Discovery Corporation, DISCA, and the strike price is 35. So we'll take a smaller number of contracts. We'll take 2 on this, and it's for April. So April 35 and 2 contracts. Now, to explain, what we're looking to end up with is no more than around 5% of our portfolio being in any one of these stocks. So therefore, that's how we can work out how many contracts. So if we had these shares put to us, it would be 200 of them at $35. So if you simply multiply 200 by 35, you get to a figure, and that should be less than 5% of what we're looking to do. So here it is, Disca, sell to open, 2 contracts, expiry was April. This thing has just started to rise. It's been running flat for quite a long time. So we want to give it definitely plenty of time. Notice the strike price intervals are in $2.50 on this one. And we're looking at 880 by 890. So by 9, sorry. So we'll just go up 10 cents, see what happens before we verify it and see what the live prices are. The live prices are slightly higher, 880 by 910. So I think we can leave that at where it is and see if we can get ourselves $8 per share. No. Now that doesn't actually disappoint me. That means that we haven't gone in too cheap. So we now need this to come through to orders. There we are. That one's Sage though. So that's what I was saying previously. For the type of trade we're doing at the moment, the lid trades are the buy to open ones. So I don't want to use some of the limited comment space that we have to put that column in until we need it, as Owen says, with more sophisticated trades with several legs. Here we go. So the trade that we've just tried to do is at the top one, Disca, and there are 2 ways of altering them. One is just little up and down arrows, but they will only go 1 cent at a time, and we need to move by 10 cents at a time. So we use this little circle. And was try and get the $8.80 from them. And now we need for these boxes, we need to wait for these boxes to populate before we can verify it again. You'll notice that basically all of the orders we're doing are limit orders. That means that we are only prepared to accept at least $8.80 in this case. There's another type of order called a market order where you say, well, we'll have whatever the market's offering at the moment. So we stick with the limit orders. And it's slowly populating. If we have many of these, I tend to do them outside the meeting because it just takes too long. Without Zoom running.
So Jeff, while you're waiting for that to populate, just Matt has a couple of questions there about the online modules. If you look at the WhatsApp chat for the group there, just if you might want to clarify where Matt can get a hold of the online modules.
Oh, sorry, I didn't realize. I thought he was sending me a WhatsApp message. I'm thinking I'll answer that later on. For the online modules, so there are 2 lots of online modules. There's the basic training that comes with your membership. You find that at smartinvestments.ai. You have to register on the front page of that site, which is free for anyone to actually register. But if you're a member, I then upgrade you to give you access to the rest of the site. You might need to let me know that you've done that. I'll verify that while we're talking. And then we've got the in-depth modules, which if you're planning on trading yourself, then you really need to go through in more detail than that does. The training that's included is really intended to give you a good insight into what we're doing and to allow you to make a meaningful contribution to the decision making. If you're actually interested in doing it yourself and getting into it in depth, then you need to let us know and we'll give you access to be able to buy the full modules. Okay. Is there 8 of them, Owen?
Yeah, there's 8 of them, and also just to let Matt know, we're planning to do the next face-to-face training in Derby on the 4th and 5th of March, isn't it, I think? Yeah,
something like that. We've also got one up in Edinburgh before that, depending on his diary and where he lives and so on, yes.
Yeah, we've Edinburgh in I think, 12th of February, and then Derby on the 4th, 5th of March, I think.
I hope this goes through because we haven't got all night with it. So again, although it says cost, it's actually will bring in $1,760, and we've got nearly $15 to pay to the broker. The broker also gets the difference between the buy and the sell, so that they're getting the difference between those two. It's not a bad life as a broker.
Well, the broker just gets the flat fee. It's the actual market maker that gets the difference.
Right,
between
yeah.
Yeah, two different companies.
Yeah. It's still it costs us. Okay, when this one goes through, I'll do the last one outside of the meeting, so we can stop hanging around for it. It's actually gone through. It's executed. It's come up on the side of the screen there. So now we're just waiting for the computer to catch up with that. And I can see it faintly in the background there. It's filled. So we asked for 2 contracts. We've got 2 contracts. So we're actually done now. So I'll do it when we finish. So I'll put it on. So basically, we took the $35 strike price. So we go 1 strike price down. Remember, it's $2.50 intervals, and we will offer to buy the right to sell the shares for that $30.50, and we'll give 10% of the money that we brought in if they're willing to give us that, and it triggers. Okay. So that's really as much as we have to do. After that, it's down to any questions. We send out the dashboard? Everyone's got the dashboard. I'll make some improvements to that next time. I think someone asked me a question and I realized I'd missed a column or 2 off, but that will definitely tell you sort of it'll give you a progress report on what your investment's worth. It is a progress report because we only actually calculate the profit when we distribute it. So it's just a moment in time one. Any questions on that, on the dashboard?
Yeah, you're going to point me at the training again. I know, Jeff. Option drag. Owen very kindly sent me a video last night, but I still didn't get it.
Right. So the money that we've just raised by selling those premiums doesn't go straight into the value of the account. It goes into that top column, which is called cash. If we can get back to it, if it ever decides to. Here we go.
So just the way I explain this, especially to people that have their own companies and issue invoices, the way I explain option drag is another way of explaining, Jeff, is that if you do a job of work and you know the customer owes you something, but you've negotiated terms, credit terms, so you issue an invoice for whatever amount of money, but you know that money's not going to come into your company for 30 days, 60 days, 90 days, 120 days, whatever credit terms you've negotiated with your client. Even though you've done the work, he owes you the money, you're not going to get the money into your account until the credit terms have come to their end. So this is no different. Every option we sell, it's got a credit term on it, and it doesn't get acknowledged as or add into our account value until the option is expired.
So the options that we've just sold, the proceeds from that, the premiums, go to this top box here, cash. Then as we move forward and they turn, one, we release the time value, and 2, the price of the stock, underlying stock, and the options change, then that money will switch across. So I hope I'm right in saying that, Owen. So where we've got some that are already in profit, here's one, the top one, January, that's 18.91% in profit. That is saying that we brought in $15.60 in premium, and currently we're looking at if we wanted to buy that promise back, it would cost us $12.90. So the difference between those two is a profit. Will that be in our net liquid value yet, or is even that not going until the end, Owen?
No, that doesn't go into the end. And if you look at the right-hand column there, Matt, if you can see, there's a cost basis, and it's very deceiving because it's minus, but it's not minus. There's in the stock market, when you buy a share for the long-term buy and hold, they call that a long position, and on your positions it appears as a plus. Whereas if you sell an option, everybody knows an option will eventually die someday. So because that's classed as a short position, it's got a minus figure in front of it. So when you say cost basis, Jeff has collected minus 1,560. He's actually collected 1,560 of hard cash, and it's been added to our cash account. But it's not added to our account value until that option comes to the end of its terms. And as Jeff is showing you there, it's got another 65 days left. So it's like we have a customer that we've given 65 days credit to, and we won't see the money for real until the end of the 65 days credit.
Unless we close it early.
Unless we close it early, yes.
So we could now say, look, we've made this promise, $15.60. We're going to give you $12.90 of it back, and we can keep the difference would then come into our net liquid value.
So you'll see that in the market value, the second column from the right there.
Yeah,
Matt, Jeff collected 1,560, and if we wanted to close it out, we'd have to give back 1,265.
Yeah.
So that difference would be added to our account value if Jeff closed that position. But obviously, it's 65 days to go. The more we hold it, the more it's going to melt. So think of it as an ice cube. Over time, it's going to melt. If we have time, Jeff, I don't know. Do you want to show them in Apex Clearing, where there's another way of looking at it in Apex Clearing, because it's really very well explained in the summary page of Apex Clearing.
Yeah, sure.
You've got your what's called your net asset value, meaning if you liquidized everything, closed everything out, and turned every position you have in your portfolio to cash. That's what's called your when Jeff opens up Apex Clearing there, we'll see it. I think it's called equity value, I think, some of that. But then underneath that, in your Apex Clearing summary page sheet, you've got what's called your option drag. You're opening up,
it's coming through. I just need to put the 5DP number in.
Yeah. So
can you see it on screen there?
No, we're still looking at the plan of security. So
can you see the 5DP number?
Yeah, so the 5DP on the screen is, fortune. Just give me 1 second, I'll get it for you.
I've got it, Owen.
You got it, all right.
Yeah, 05635. 05635.
So Matt, every club member has access to the Apex Clearing website, which is like the back office for the account. Like Alpha Plan, what you're looking at there is just an execution only platform. It's not where your hard cash is. The club's hard cash is actually sitting in our clearing account, which is just like another bank account. It's like our US dollar bank account. And every broker needs a clearing firm. And in this case, Apex is the grandfather of the industry. It clears for about half the industry. So what Jeff has shown you there, you've got your account equity, which is 163,217.
That'll be as at the close of business yesterday, is it?
Yeah, as of close business yesterday. And then you've got, see where it says balances on the right-hand side there, Matt. Balances is pure cash. So, I wish they would call it plain English. So why don't they call it cash? Because that what it is actually cash. So your balance figure of 202,000 is your actual cash, hard cash. And then you've got, if you scroll down a little bit there, Jeff, you've got your option value, which at the moment is negative 88. See there? So you've got your equities value 46,000. You got your negative option drag 88. That's literally dragging your account down by negative 88,000. But Jeff will keep all of that for the club, because either the puts will end up above the strike price and he keeps all that money, or he'll push it forward, give it more time to be above the strike price, and he'll get more money to push forward. So bottom line, Jeff is going to turn that negative 88 into positive 88, but it hasn't happened yet. So you can do a quick calculation in your mind and say, we're worth 163, but we're really worth 163 plus 80. It's
Okay.
86, isn't it? 86.
Yeah, it's
right?
86. Yeah.
Yeah. So you can do, any club member can go to this website at any time and just do a quick mental calculation, say 163 is our liquidation value if we liquidize everything today, but we've got another 86 coming down the line when our invoices get paid. So we're really worth 163 plus 86.
I'll put the details of how to get to this in the WhatsApp group. But when you get, this is the front page, so these are all sort of expandable as menus. But also up on the top right here, you can get to the account statements. The confirms are simply confirming each of the trades that we've done. The tax forms don't become relevant until the end of the year, but that's where you can get all of the statements.
Okay.
Yeah, and also if you click on, yeah, Jeff's showing you how you can get a statement there. Yeah, cool.
So yeah, they're all there, whichever one you want. You can go back and get them in time.
Yeah,
Okay.
and if you go back to the other previous page there, I think it's the one there to the right.
Because it's,
There you go. So you see there, Jeff, if you click on where it says margin on the right-hand side, it says balance details.
yeah, it's actually disappeared now.
No, we can see it still. Yeah.
Can you?
Yeah.
I can't.
If you alt tab on your keyboard, maybe alt tab, it'll.
Oh, I can't see the tabs because of the.
Clean your glasses, Jeff.
No, it's not that. No, it's definitely I haven't got another tab there. Oh, I close that one down. Right, I've got it. Yeah.
Yeah, so click there, Jeff, to the right of the word margin that says balance details. There's a little white arrow pointing right. If you click on that. So folks, if you want to go drill down into each position we have, and you want to know which one is using up the most amount of buying power, you've got some headings here. And if you click on the maintenance requirement or maint.req, so
Sorry.
you want to scroll down a bit more, see you've got your headings there, yeah?
Yeah.
Right inside you've got a heading called maint req.
Okay.
You've got option strategy, and then to the left of that you've got concentrate requirement. And then click on that one there. So by clicking on that one and then click one more time again to bring the so the one that's using up the most amount of buying power there would be EDU, and then the next one is EBS. So you can see of all the buying power I'm using, which one is using up the most amount of buying power. So if ever we wanted to release buying power or boost our buying power, we can always go in here and see which one is using the most amount of buying power. So another thing to notice here, if you look at a stock position, like say, if we pick what's
Sage.
Sage. So Sage, it has a market value of, if you see under the market value heading, it's got a market value of 8,354.
Yeah.
But it's only using up 3,759 of buying power. So that means it's roughly 2 to 1. So for every $2 of market value, it's only burning up or eating up $1 of buying power, whereas other companies will be different. So if we scroll down a bit to another company,
There's gap underneath it.
Yeah, so gaps, has that been put to you?
Oh no, sorry, no, it's still.
You go down to another stock position, yeah. So we scroll down to another share position we own. So like, so for example, HBI, that's got a market value of 5,300, but it's only tying up 1/3 of buying power. So that's stronger. It's 4 to 1. So for every $4 of value of shares, it only requires $1 buying power. So different companies will have different ratios between. Go ahead.
What determines that ratio, Owen?
It's a couple of things. It's the financial strength of the company, Matt, but it can also be the global exposure that Apex Clearing has to that position globally, because Apex will be the granddaddy of the industry. There's about 200 online brokers, 200 alpha plans, if you call it. And of those 200, at least half of them, every broker needs a clearing firm. Apex is the clearing firm, but Apex is the granddaddy of the industry. They've been around for about 40 years. They clear for about half the industry. So what they will look at electronically every day is, of all our, say, 100 brokers, and underneath that, of all the thousands and thousands of clients that those brokers have, what's our global exposure to, in this case, HBI? And if it's a very small percentage of their holdings, they're more comfortable to give a 4 to 1 relationship between account value to position value to buying power versus if a lot of brokers were, and a lot of clients in a lot of brokerage firms had an exposure to this position, they would drop it down to 3-1 or 2-1 or in some cases 1-1.
So it's actually also one of the factors I take into account. So I start off with a long list of potential trades. I'm looking at the risk to reward ratio. I'm looking at the forecasts that we do, that Value Line do, and I'm also taking into account the buying power and the percentage gain if the stock is not put to us, and the percentage gain if it is put to us. So I rank them all on those things and try and get the best balance. And that's what I did to get to the trades that we've done this evening.
Okay.
And then if we look at VIRT as a put, this will really maybe bring home to Matt that every option we take has got a certain amount of, I think we scroll up there, VIRT was near the, let's see. In fact, if you go to the very top there, Jeff, you can type in the symbol to just bring VI. See what's the symbol there? You can type on VIRT there, where's the symbol. So if we just take VIRT in isolation, Matt, it's one of the many puts that Jeff has in here. But if you look at it, he's promised to buy VIRT at a promise price of $29. See, we're on the description, it says VERT, 17th of December and $29.29. So Jeff has promised to buy that at 29. It will expire on the 17th of December. Jeff, can you see on your other screen what VIRT is trading at the moment?
It's at 28.78.
Yes, this is a great example, Jeff. So 28.78 is what it is in the market today, Matt, and Jeff has promised to buy it at 29. So he's only underwater by 22 cents. He's 22 cents away from the promised price. Yet the price of that option is 1.17. See where it says price there, Jeff? You want to point the mouse to the price?
Yep, got it.
So the price of that option is 1.17. So when you think about it, it's only 22 cents underwater. So we take away 22 cents for 1.17. It's 95 cents of pure time value. So as time moves forward, let's say if we could freeze the price of VERT, like in the real world, shares go up and down, you can't freeze them, but let's say we could freeze VIRT at the current price of 28.78 on the third Friday of December, the 17th of December, all of that 95 cents will have melted away in our favor. And that's another big contributor to our negative option drag, because we're being dragged down by 1.17. But that's not fair. We should only be dragged down by 22 cents. Gotcha. The rest is just time value that has yet to expire between now and the
So we actually got for that $4.40 per share in option premium.
Yeah, so that's already melted almost 75% in our favor.
Yeah.
So embedded within every position we have, there's a certain amount of time value, which will eventually be nothing on the third Friday. And there's a certain amount of intrinsic value for below the strike price. And that's contributing to that big minus 88,000 that we had in there. Each one of those positions, that one is negative. See, that one is negative $234.
Yeah.
So that's one part of the whole global 88 grand that we're being dragged down. So that's why we call it option drag, because it is literally dragging our account value down by that amount of money. But we know we're going to get to keep all that money over time.
Okay, so it's like an extended line of credit.
It's exactly like that, as an extended line of credit that we will eventually realize and will be added to our account value.
Okay. And one last question. So the cash out value then, the cash value, that 202,000, that's the account equity plus the value of the equity sitting on the account, yeah?
If we go back to summary, we can see a kind of a summary picture there, Jeff. We want to go back to summary in the top left-hand corner.
If anyone thinks I'm asking too many questions, do shout and I'll shut up.
No, brilliant, Mark, because this is so important, because what happens when share prices go down, option drag goes up, and so many people focus just on our liquidation value and they don't understand the option drag, and they freak out because, oh my God, my account value has gone down. We're not really making progress here. It's very important that every club member understands option drag, because then it stops them freaking out when account values go down. So yeah, now we're looking at the global picture. So we've got this kind of four figures we've got the liquidation value, which is 163,217. That's your true liquidation value if you cashed everything in and pulled out your money today. The balances of the 202, that's all the cash that it's like, Jeff is a great, what word do you use again? It's cash reserve, isn't it?
It's the cash reservoir.
Yeah.
The profit reservoir.
It's his profit reservoir. So, because that 202 is, he can use that to allow other shares to be put to him. So he's already built up a reservoir of cash that he can use to buy future equities. So that's a very important figure as well.
So we keep filling this reservoir up, and we're basically, to carry on the analogy, we're building a pipeline so that each month some of that money is coming into the account, net liquid account value.
Yes, and it's also a treasure chest of he can afford, the club can take ownership of $202,000 worth of shares. He's built up a big reserve that he can happily take ownership of shares, and he's got plenty of cash to back up his commitments. And then if we scroll down a little bit, there's three figures there a little bit, that you've got your equity. So the shares that he has already taken delivery of and have been put to him, the shares he currently owns are worth 48 grand, but his negative option commitments is negative 86. So that's why the overall market value is the shares versus the option drag. His overall market value is negative 39. So when you go back to Alpha Plan, you can see in Alpha Plan, everybody always asks, see if we click on Alpha Plan, you might have to do a different screen share now. And obviously those figures we were looking at today were close of business last night, because Apex only gives you an end of day valuation, but Alpha Plan is like changing every second of every day because share prices are moving. So if you want to go back to share now, Alpha Plan, please, Jeff. We're still looking at.
I'll have to go back to get to it.
So whenever that comes up, the critical thing we always look at in terms of like stress testing the account is we look at the value of our liquidation value if we liquidate everything and turn it back to cash, and the relationship of our buying power to that. And we keep our buying power always greater than or equal to 50%. So if your account value is worth 200,000, your buying power should always be worth north of 100,000. And then above those two figures, you've got your, I think they call it equity value.
Can you see it?
No, we're still looking at Apex there, Jeff, if you want to do a fresh share. Yeah.
There you go.
Yeah, it's coming up now. So you see there, folks, in the top right-hand corner, you've got three figures. You've got your net liquid value. That's right now, if we shut down every single position, we'd have in 2 days' time, because it takes 2 days for your cash to clear. In 2 days' time, that's our bottom line net liquid value. Below that, you've got your buying power. And above that, you've got your total market value. That's the value of your equities minus your option drag. So that's where that comes up with minus 44. That's the real figure now. Yesterday was minus 48, but today is minus 44. So it's improved by 4,000 from yesterday to today.
Yeah. Okay. Brains suitably addled.
Yeah, that's really valuable. Thank you.
You're very welcome, Matt. Thanks for asking questions. So when we look at account value, we've got about 29 grand to play with there, Jeff, is it?
Yeah. It's about that. It was about 35 before we set off today. Yes.
Yeah. So those three trades that Jeff just did there, Matt, those three trades are using that surplus buying power, surplus to the 50%. Our account value is 160. To keep them out simple, half of 160 is 80. So because we're 109, he's got 29 grand reserved that he can use.
So you say we're taking this 161 and saying half of that. So half of that in round numbers is 80 for stock buying power, but we've got 109. So we've got the best part of 30,000 still to play with. So even daily, but certainly weekly, we're looking for new good trades all of the time to use that up. And this week we'll get some expiring options, which will put more cash in, and off we go again.
Yeah, which is very, very powerful, Matt, because Jeff has already collected 205 grand of cash, and he that's all sitting as a reserve. He can sell puts and be comfortable that he has the cash reserves to take them if they choose to put them to him, or if he chooses to accept them.
Which,
Okay.
And that's
but we're talking
even-
about the spread of there's some December out to March, April. They're very unlikely to put them all, or high proportion to us.
Yeah, that's why we spread them out over time, Matt. So they couldn't put them all to us on the 1 month and put us under pressure if we didn't have enough of cash to take them. We always spread them out over the next 3, 4, 5 months.
And
And
we've got 48 trades in progress there.
Yeah.
That's
So
on the
there's
pending orders. So it's 48 trades. They're actually the pending orders of the lids. So we've got the stock on top of that.
There was another question coming there, Matt. Did you, or somebody answer the question?
No, I'm good. Thank you.
You're very welcome, Matt. Was someone
Yeah,
else?
so-
jumping in?
I was just going to say, I take it that covers us if any of them are put to us.
Yeah. What's your budget at the moment, Jeff? What are you allocating per position?
We're it's 5% of
About
160.
8 grand. So is it?
Yeah.
So if you do the maths there, Murray, if you take his 205 grand and
Yeah,
divide
8 grand.
divide by 8, what's that roughly?
What were you doing? Sorry.
So we take our 205 grand of cash that you've accumulated, divided by 8,000. That will tell us how many positions we could take.
Yeah.
That's
25. Yeah, got you.
Yeah, so he can comfortably take ownership of 25. He's got 48 in the pipeline, well spread out over the next 3, 4, 5, 6 months. But right now, he could comfortably take 25 of those positions.
Yeah, so this is a moving target all the time, isn't it? Hence the
Yeah.
reason you spread them out.
Yeah. So it's a production line, so it's very powerful.
And a fair old proportion of them are in profit anyway.
Yeah. So it's roughly a third. A third of the puts you do go up and never get put to you, and they never will be put to you. A third of them kind of stay about the same and may or may not, and a third of them are candidates to be put to you if you want to get them put to you. So when you think he's got 48 positions, only 1/3 of them. So if we take 48 divided by 3 in the real world, 48 divided by 3 in the real world, he's only 16. Yeah, so he's only going to come under pressure to take 16 of those, and yet he's got a cash reserve to take 25. So he's well, everything's under control. So if you want to stress test the account, that's the sort of things Jeff and I would do on a daily or a weekly basis. We'll look at the big picture, and that's what the dashboard helps us do as well, to see, do we have plenty of cash reserve? How much commitments do we have out there? What would happen if we took a third of them? No problem. We've got more than enough of cash to take a third of them.
And at the same time, you've got money in the market working. You don't want to have too much in reserve, I take it.
Yeah. So we've got almost 4 things going on. We've got our shares are going up in value over time, which is making us money. We've got our put cash coming in, which is allowing us to buy even more assets. We've got our dividends of the shares we own. So that 48 grand of shares that we own, that will be bringing in some dividend income for us. And then when the shares hit the high points, we're going to be selling calls as well, which will bring in more cash that we can use.
And then, so before we started tonight, I actually checked the stock buying power that we had, which is about 32,000. And on the trades that we were looking at doing, what they would cost us as an estimate of stock buying power, and that was 10,000. So I knew I had checked before we set off to make sure that I wasn't going to be spending money that was going to use too much of our buying power and put us in danger.
It's always good to keep a bit of buying power in reserve, Murray, because especially we're coming into earnings season, there's always the odd share drops and gives us a great opportunity to get in at a nice cheap price. So it's good to keep a bit of buying power in reserve as well.
And earnings season's first quarter 2022, is that right?
Yeah, well, different companies have got different year ends. Some companies have December. Majority of companies have a December year end, but there's plenty of companies out there have November year ends and April's and different ones. So
Okay.
there's always opportunities almost every month to. But the big bulk of them come in on January after December. You know, it's let's say April after March, July after June, October after September, and January after December. They're the big opportunities where we get a lot of shares announcing earnings, and there's always going to be someone missing the target, and that gives great entry points.
Yeah, so I mean, we actually like it when we know they're a really good, fundamentally sound, profitable company, and they miss their earnings by some crazy small couple of cents, and the market sort of downgrades them. That's a great chance to get in, and then you find out, you know, within a day or two, the market's come to its senses, have forgotten about it, and moved on, and it's back up again.
Yeah.
Makes sense.
Okay, so sorry, I've got one last question. I can only apologise.
It is a last question, because if we don't get off soon, I need to let this render and record, because I've got another meeting coming up.
All right. So yeah, one more
Go on,
question.
get your question in, Matt.
One more question. If we're looking at the overall performance of the fund, at the moment we're about 8-9 months, aren't we? Something like that. So if we then look at the profit with no drag, would it be right to divide that profit percentage by the number of months to give a rough monthly performance?
It would, but the one thing you need to allow for, Matt, and maybe we'll do a session on this next month, Matt, is you got to allow for the drip feed part of it. Because if you think of it, if you invest 100 grand and let's say you make 20 grand profit, you've made 20%. But let's say you add another 100 grand, now you've diluted your profit down to 10%. So we'll show you a drip feed calculator, which give you the true per month return. We'll show you that.
We've got it's fresh money going on all the time. It doesn't reduce the profit, but it dilutes the percentage.
Understood. No, I got that completely. That was a very useful video you shared last night, Aaron. That was
Yeah, thank you.
I'll shut up now.
No, that's great, Matt. It's great. The more you ask, the more you understand. So it's brilliant. It gives the opportunity to explain to other people as well. Yeah.
Okay.
Yeah. So we'll see everybody next month again.
Right. Thank you, everybody. So I'll edit this and have it up out tomorrow, and I'll also put on WhatsApp the details again of how to get into the Apex screen to see it directly for yourselves. Okay.
All right. Take care, guys.
Thank
you.
you.
Thanks, guys. See you later.
Bye.
Cheers, everyone. Bye.
Bye, everyone.
Bye.